Hari of Vanda Insights, joining you from Singapore. I am the guest host today and for the next 2 days. And it's my absolute pleasure to welcome today Peter McGuire, CEO of XM Australia, Vladimir Langhamer, Managing Director, Supply and Trading at OMV, and Robin Mills, CEO at Qamar Energy. Now, some analysts are seeing this as a toxic troika week. We have the growing jitters over the Chinese real estate group Evergrande and its spiraling debt crisis. There's a fair bit of apprehension over what Jay Powell might say after the Fed's tapering and the dot plot on Wednesday. And then there's a gridlock in the US Congress over the government's soon to expire debt ceiling. So a perfect storm in the financial markets. Meanwhile, there was quite a big news story on the oil front yesterday. Shell is exiting the Permian less than 10 years after having bought those properties. It's selling all of its Permian assets to ConocoPhillips for $9.5 billion. It seems we are now in a shifting wave. There was a time when all the majors were getting into US shale, and perhaps this is the start of a U-turn from there. So we had crude futures slumped by 2% nearly yesterday, but they have clawed back nearly half of that ground. I'd like to start with Peter. You've been watching the Australian markets and the Asian markets. And of course, the Evergrande crisis is the talk of the town, not just in Asia, but globally. While clearly there were other factors in the risk asset sell-off that we saw yesterday, do you think the fears over an Evergrande contagion are overdone, or do you think one still needs to be on basically edge of one's seat?
Well, good morning to everyone. I think you need to be on the edge of your seat. We understand that China's been shut for 2 days, so there's the first part of it. Hong Kong's still down 0.3% today, and its broader market's down nearly 0.7%, Vandana. So it's been a mixed bag. Aussie's up about 0.35%, but you've got the Nikkei down about 2.2% and everyone in between. So it's a choppy day. Some of that momentum pushed down. The uncertainty is how the debt is handled on Thursday, as far as that, I think it's about 80 odd billion that needs to be financed. I've got the notes there somewhere. It's an enormous amount of money. And remembering they build 600,000 properties a year, the great concern is what happens to those investors? And it's all majority bought off the plan. So the Contagion, the second largest property group in China, it's going to be a hard one to manage. And could this be the start, or may it, we see some form of assistance from the government? It's, I think, too early to call, and it could be a very, very interesting week as it unwinds.
Yeah, could this be the start? Actually, that was going to be my next question for you, because we know there's a lot of tectonic shifts going on in China, right? Like, where does one start? Even all the crackdowns by the government on various sectors. Do you feel, I suppose this is more of a gut feel really than anything else, but do you think that this could be just the start of an unraveling in more corporate giants in China?
I wouldn't be surprised. I think the debt, and how many other Evergrandes are there? That's the concern. They're a conglomerate that encompasses electric vehicles. As we know, they build and operate theme parks as well. The financing, you've got 171 domestic banks and you've got 121 financial institutions that make up, how they arrange their finance or arrange their funding, and the knock-on effect to emerging markets and the internal side as far as China. So it's too big an argument to just say it's all going to be settled and it's going to be just a walk away. The stock price is down, I think, the best part of 80%. So how it unravels, no one knows, but I think it will be messy. And it's just how many other Evergrandes are out there built on debt. Reminds me of those wonderful entrepreneurs in the Western Australian mining sector in the early 80s that built everything on debt. Eventually, you've got to come a judgment day to repay.
Yeah, so the nervousness is quite justified indeed. Vladimir, I'd welcome your view on the overall economic situation, the deceleration in China's industrial and retail sectors, and how do you see that panning out in terms of Chinese oil demand recovery?
Yeah, good morning from London. It is certainly of a concern. I mean, I can't remember the last time we discussed about the failure of a real estate company, but yes, the oil market is discussing the Evergrande because there is potential that it will have a wider impact on China growth, so GDP growth, right? Especially if there's more of those, and already the demand is not as high as many people have anticipated. It has slowed down because of the crackdowns in the last couple of months. But it seems also because of the slowing internal demand, a real demand, if you want, in China. But to a large degree, I would think this is kind of priced in already. Yeah. So the kind of flash outs that we had in August and in July, where the price kind of whipsaw down and up, that was also part of it was China and kind of economic information piling up over a relatively short period of time, and the market has seemingly overreacted. So this is something that the markets are watching. But I mean, on the other hand, you have a good demand coming out of US, you have a good demand coming out of Europe. And I think in the oil market there's now a bigger fish to fry, which is gas price and CO2 price in Europe and either locally. So this is another layer, but I wouldn't say the major push at the moment.
Yeah, sure. Exactly as you just mentioned, the other crisis that we've been talking about for the better part of a week, Robin, is the European gas shortages and the price spikes in gas and electricity, certainly, but a knock-on effect on some of the other industries as well. Do you see, we have in our reading list today, Goldman Sachs actually warning, or perhaps it's not a warning for them, they're probably happy, being the eternal bulls, that there's going to be a huge demand in fuel oil as a result of this gas shortage, and that they think will lead Brent to climb to $85 a barrel in the first quarter of next year. If I may get your thoughts, Robin, on how do you see this gas shortage and its potential impact on oil?
Yeah, I mean, look, it's really a super interesting and complex story, isn't it? So, we're very much focused on the European gas shortage, including the UK, and that's very, very significant. Obviously, for the gas markets, and finally, gas and LNG are back in fashion, and gas producers are actually seeing half decent prices. In the case of the US, for pretty much the first time in a decade, and the LNG industry, if you think back to 2018-19, was incredibly gloomy, and we're talking about a glut out to the mid 2020s, and now we're looking at a shortage, and people are finally serious about building LNG plants again. I was at a conference yesterday, and there were two LNG developers there, and I'm like, wow, you guys have got budget to be flying around the world again. So so that was that's pretty interesting. I think the other side of this, we've just been talking about China. China is also actually facing a gas and power and a coal crunch. China is competing for LNG supplies as well. In fact, of course, China is a big part of driving up the LNG price as much as it has. But China is also getting short of coal because Chinese mining has been cut back for safety and environmental reasons, and because, of course, China put an unofficial embargo on importing Australian coal. And so actually Chinese utilities are finding it hard to get hold of coal ahead of the winter. That puts more pressure on LNG. And as you say, indirectly, then that puts pressure on oil as well. So, I think we're going to see more fuel oil burn in China, possibly in Japan, and certainly in other countries that have been importing LNG, like Pakistan, like Kuwait. We're the strange and unusual scenario where LNG is significantly more expensive than oil right now. So absolutely, that will put pressure on oil as well.
Yeah, this could spiral out into a global crisis indeed. So exactly as you mentioned, Asia is already feeling the pinch of the gas shortage in Europe, and now there's some concerns that perhaps US might see some knock-on effect coming winter as well. Coming back to the Fed and central bank meetings, Peter, you were mentioning to me earlier that there's quite a few central banks that are meeting this week, right? So how do you, in general, I presume you'll be keeping an eye on what they say and do, but how do you in general see them juggling these twin imperatives of keeping inflation in check while also boozing the economy with easy money?
Well, that's the interesting point. You've got Switzerland, Indonesia, Bank of Japan, Bank of England, and the Fed. I may have missed one or two others. So it's a dynamic week, and then you've had elections, Canada and Russia and Germany this weekend, and of course finding a new prime minister for Japan, all in a period of around about 9 days. So how does it play? The Fed, I'm not expecting, I think it's more dot plot. Where are we as far as the meeting concluding at about 1800 tomorrow, 1800 GMT tomorrow, that's Wednesday. And the risk as far as inflation is the great concern from the spending power as far as the man and the woman on the street. That seems to be the hurt factor, and how they're going to contain that. It's very, very high in Australia as far as food costs, fuel, and all the other associated. I'm not sure how it is the rest of the world, but I'm pretty sure it's in the same boat. And then naturally, what do banks do with cheap money or free money? And how do they start to ratchet up? We've got booming house prices in Australia and certainly in the US, and they tell me in the UK as well. So it's been, and Canada, one-way traffic. So that's a concern. And then the next concern is when do you start ratcheting up? Is it next year? Is it mid next year for the Fed? And I'm not expecting surprises really from J-Powell tomorrow. I think it'll just be they'll push it out to November as far as taper talks and when they'll start to pull that 120 billion a month off the table. So or in smaller tranches. So there's what I'm thinking. And US dollar index, keep an eye on it, 93.15 at the moment.
Oh, yes, at 1 month highs as well. Talking of gas prices, Peter, is surely Australia as a producer and exporter is in a position to take advantage of the situation on a net. I know inflation is a problem as well, but on a net basis, do you think Australia comes out a bit of a winner from this high gas prices?
Well, it probably does from an employment standpoint and for some components of the economy. But if you're not associated with it, you're just in a large city like Sydney, and you're not, it's no benefit to you. It's a benefit to the overall economy and your GDP. And but to the man and woman on the street with lockdowns, and we're now in month 3, it's a different mindset. It's more or less, the economic carnage across Australia is monstrous for small family businesses that have just been decimated. So there's the storyline that I think people are more focused on as far as survival mechanism or survival mindsets.
Yeah. Vladimir, I'd love to get your perspective from your perch, and you're in London today, and I understand UK is probably right now suffering the worst fallout from this gas crisis. How do you see that sort of unfolding around you in UK or in Europe at large?
I think I'm not really in the gas markets, but so it's more about what you read on in the newspapers. I think the fear is much more about kind of gas suppliers falling over, because their business model has been buy the cheap gas in summer and hope it's gonna it's gonna go up in the winter. They didn't do so much in this summer, and now obviously suffering with the prices, with some of the kind of end consumer contracts being locked in with a price. So the small ones, the less unstable ones, they are potentially falling over. I mean, you had dozens and dozens of suppliers in here. And that's it's probably going to purge the market. The government is the government is urging the public that they're not, there's no issue with supplies or physical.
Don't
supply.
panic is what Boris.
Yeah, and I believe so. I mean, is the demand so much bigger than last year? I don't think so. Yeah, I mean, there was a shortage certainly coming from Russia because of some supplies. Which then spilled over into UK because there's no direct supply. But I think it's a bit overplayed. Of course, this mattered to the people on the street, as Peter says, because they will be paying higher energy prices. And I think people got used to the very low gas prices, which we had in the last 3-4 years. And now it's on the other extreme. But, looking back maybe 10 years ago, it might not see so severe.
Let's talk about geopolitics, which is always in season for the oil markets. And Robin, we have a story in our reading digest again today. Apparently, the Saudi Energy Minister, Prince Abdulaziz bin Salman, who was addressing an annual general conference of the IAEA yesterday, he blasted Iran for non-compliance with its nuclear commitments. And just generally following from sitting here in Singapore, the talks between the US and Iran that went on for some time and didn't produce any results seem to be quite a bit on the back burner. But there's been a fair amount of headbutting in recent weeks between Tehran and the Atomic Energy Agency. The consensus view in the oil market from, whatever I hear people referring to the Iran the sanctions issue is that at some point the deal will be resurrected, perhaps next year. Would you agree?
Yeah, look, I think the Biden administration had that little window of opportunity right at the start to rejoin the deal, basically on the terms as originally agreed. And they didn't do that. They chose instead to try and negotiate and think that things would change and perhaps Iran would be under more pressure. And of course, then because of that, they missed that window. The Iranian elections came along, a new team in place, and a new president, and he's got his own people that he's bringing in, and they are generally thought to be a more hardline approach. And the Iranians, of course, have been pushing back and testing the limits of this deal, I think, and that's been a consistent tactic of theirs to engage in some violations that are not so egregious that the whole deal falls apart, but there are just enough to test its outer limits, and then if they really get called out, they step back a bit. But the Iranians have to do something because they can't just sit there and accept being under these US sanctions forever, and waiting until Biden's in his good time comes to negotiate with them more seriously. So they feel they have to keep up the pressure on him in some way. Yeah, look, I think the expectation is still that there will be a deal of some kind, but the US is I think showing no urgency for it at the moment, and the Iranians also kind of think they can wait it out for now. Their oil position has improved a bit, enough to take some of the pressure off them. Managed to get out a bit more exports, and they're of course consistently developing ways to get around the sanctions. And I think they also feel that their own position has improved a bit. The US exit from Afghanistan, that creates actually some problems for Iran, but it also is a blow to US prestige, and I think makes it clear that the US is less and less willing to take an active forward military role. There's no appetite in the US for further military action in the Middle East or in the wider region. So this could drag on for quite a while, I think, until that dynamic is broken. And I also think the current.
Sorry, go on.
Please, no, go on. I was just going to say that I think the current team, the Iranian team, they are, the general thought has been if they do strike a deal, they'll be quite good at making sure the Iranian system delivers, but they're not as good at striking that deal in the first place as Rouhani's team were. They're not as experienced, and they also come at it from a more negative point of view. Yeah.
So how do you see it? It's simply about which side blinks first now? Is that all there is to it now?
I don't, to an extent, but I think it's also about which side puts. I think for the US side, does the US put priority on it? Biden's got a lot on his plate, and mostly domestic issues that he wants to get through. And then, of course, there's the US, Australia, UK deal diplomatically. So he's got other things that he's put as priority. As long as the Iranians don't really look like they're going to blow up the deal and really make a breakthrough on nuclear capacity, it's there's no rush. And for the Iranian side, they're surviving. It's not comfortable, but they're surviving, and they would rather carry on than drag that out. And ordinary people suffer, of course, but they can drag that out as long as they're not in danger of collapse. And just see how far they can push the nuclear activities. I don't think that they're making a rush for a bomb or anything like that, but they are trying to improve their negotiating position.
Okay, fair enough. Let's have the survey question and get all our webinar participants in today as well. So our question today is that the fears over contagion from China's Evergrande debt crisis was a major factor behind the sell-off across the markets yesterday, which saw crude futures slump by 2%. How do you think the situation will end? The upheaval will pass. It's just a temporary phenomenon. Maybe the company just restructures. Or do we see an impact across at least the Chinese economy? Or do we see this as an impact across the Chinese economy, which in turn spills over to the global economy? So please cast your vote. I have to say I might have been swayed a little bit by Peter's views on this. So, Peter, if you could unpack a little bit more for us about what you were mentioning, you expect the Fed to do. I have been reading some reports and suggestions that given that how much the markets are already on tenterhooks, volatile, there's the Evergrande thing happening, then the US debt ceiling crisis, that the Fed will not rock the boat, especially in times like this. From what I understand, we are expecting, however, to get a little more clarity on when the Fed begins to taper its asset purchases, and perhaps on a rate hike. Would you agree with that? What are you expecting to hear from Powell this week?
Well, I think another thing that needs to be added, and I agree with what you've just mentioned, but the other side is the employment numbers that were very weak in August, and we're only a week and a half away from the new numbers for September, that non-farm payroll, the first Friday of the month. So there's the storyline that I like to drill down on. We've got the inflation story. We understand that not expecting any surprises coming tomorrow from Fed Chair Powell. I'll push it out to November, the dot plot configuration, and then I would say maybe a rate rise mid-year next year. Now, that's what everyone's thinking, but there's a lot from a trading perspective to take on board. First off, how deep is the inflation story? How much of a contagion, and we might be sitting here in 2 weeks' time and Evergrande's gone. It's all finalized, no problems, no damage, or we might be sitting here in 2 weeks' time and the Dow's down 10%. And the crude's at $60, and there's a wipeout across all of Asia Pac and a lot of the other emerging markets, and certainly the more mature ones. So there's the story that I think needs to be considered. The COVID numbers ramping up in the States, they haven't got those under control. The storyline as far as Delta, and it's just very much a wait and see. Our business is primarily on short-term trading, so we're only looking for principally opportunity, but there's certainly going to, I think, the volatility over the next month or two could be dramatic across the currency and commodity sector. Have a look what's happened as far as iron ore in the last month and a half or month and a bit, down the best part of nearly 25%.
Sure. Vladimir, if I may turn your attention to the disruptions in Libya last week, and that was certainly one of the contributing factors last week when it was all bullish sentiment in the oil markets. Now, these were public protests that had disrupted crude loadings at 3 Libyan ports, but as the week came to a close, by Friday, Libya's NOC said everything is back to normal, and all crude loadings are taking place as scheduled. But it is a reminder, isn't it, of the fragility of peace in Libya, especially ahead of the country's elections, if indeed the elections are going ahead. Do you foresee Libyan output outages in the coming months adding to the overall sort of supply tightness from in the market?
I would see the Libyan news adding to a sentiment, because that's what really happened this past 2 weeks. If you look at the magnitude of the real disruption, I mean, there are a couple of ships that maybe loaded a bit later or loaded 50,000 barrels less, or had to kind of rebirth. There were disruptions, but really in the large scheme of things, there weren't. There were a lot of news around it. I think the positive news about that was it was not caused by a militant clashes or
Exactly.
militant groups. Yeah, it was really, it seems like civil groups. There might be some kind of expression of a power struggle ahead of the elections, so I would expect to see such things going forward as well, but I wouldn't expect not to the extent where this was really majorly disrupt the real flow. But as I said, the sentiment certainly, because it seems that it's not just, I mean, the market, you can argue if it's the sentiment and driving the markets or the markets kind of driving the sentiment, they're certainly both very jittery. And any small news that is contrary to the main view, which is largely bullish, I would say still in oil, calls for a big sellout and trigger of technical levels and what have you. So, but in Libya, certainly ahead of the elections, and then we'll see, after the elections, because there are many groups, and this will be a major test that the elections have been postponed and are kind of being done on the last possible date. So I hope for the country that it will go well and people will find an agreement. But until then, it could be very rocky.
Indeed, let's hope peace and order prevails in Libya. Can we have the survey results, Irene, before going to Robin for the final thoughts? Okay, quite divided again. 31% say the upheaval will pass. 48%, that's the majority as of now, that it will at least have an impact across other parts of the Chinese economy. 21% think that this could spiral out to the global economy. Thank you so much for your votes. Robin, something that I certainly was watching with quite a bit of interest, and I think this is quite a pertinent issue for the oil markets. If you looked at the OPEC, non-OPEC production in August, and then, depending on whose numbers you're following, but there was a huge shortfall of anywhere between 600 to 800,000 barrels per day in August versus the alliance's new raised ceiling. Do you think that the handful of bigger producers within that alliance who are actually have the capacity to ramp up will be able to pick up the slack, or do you see a new problem cropping up in the coming months and perhaps the coming year as well, that OPEC Plus is just not able to ramp up in tandem with the recovery in global oil demand?
Yeah, I think this becomes a concern later on. I'm a little surprised by the August figures, but I think, definitely later in the year, going into next year, this becomes a concern that, everybody's production ceilings increase in kind of stepwise. Some of the countries like Saudi Arabia, UAE, can achieve those ceilings and pretty much stick to them. But increasingly, some other members can't. I'm looking at Nigeria, Angola, Algeria, those three in particular. And then, of course, as time goes on, they fall behind. And then the problem is, well, okay, so then OPEC is behind its overall ceiling. Market gets tighter than they would prefer. Then they could say, well, okay, so let's readjust the everybody's ceilings, and then it's acknowledged that Angola can't actually produce what it's supposed to, and that increase gets allocated to some of the members who can. But of course, Angola and Nigeria and so on, the others will resist that. And we already had a bit of a bust up when the UAE wanted a higher ceiling, and that eventually was partly accommodated. But you can see these issues are going to be controversial. Nobody wants to give up permanently their production rights, even if they can't actually use them. So yeah, this does become a problem. I think I was as I say, a little bit surprised that it was striking in August, but definitely by the end of the year, when you look at what Angola and the others are supposed to be producing by then versus what they actually can produce, yeah, the gap is increasingly wide, and at some point there'll have to be a discussion about reallocating that, but it won't be a comfortable discussion.
Sure. Before I let you go and we close the session, can I have some very quick thoughts also on what's happening in Nigeria? We have, again, in today's reading list, NNPC's privatization, which seems to be almost all complete. Do you see that producing any sort of a major change in Nigeria's oil sector?
Yeah, so I mean, we just mentioned, Nigeria is struggling to hit its targets, so it obviously needs to do something different. The incredibly long drawn out petroleum industry bill that has now passed finally, so a new framework for investment in the sector. I think, generally that was received positively, felt to be an improvement, particularly for the deep water. And now, as you say, the restructuring of NNPC, possibly allowing that to float shares. I wouldn't expect that to be a quick thing. I mean, President Buhari moves pretty slowly on these issues. He's acting oil minister as well, of course. So I don't expect that to be particularly quick, and I don't expect NNPC to get transformed that quickly. But maybe further down the road. I think the passing of the Petroleum Industry Act is probably more significant because there are a number of, especially deep water fields that have been lying there for years, not developed, that now the companies could move ahead with. So that finally might be reviving Nigeria's production capacity.
Yeah, let's hope so too. Peter, Vladimir, and Robin, thank you very, very much for participating, as well as all our viewers who tuned in today. And we'll close the session here. Thank you very much.
Thank you. Bye-bye.
Thank you.